Imagine your money is on a roller coaster, but instead of random ups and downs, it's tied to the heartbeat of America's biggest companies. That roller coaster? The S&P 500. So what exactly is the S&P 500? It's short for Standard & Poor's 500, a stock market index tracking 500 of the largest publicly traded U.S. companies. Think Apple, Amazon, Microsoft, and more, all bundled into one giant financial snapshot. Why does this matter to you? Because the S&P 500 isn't just Wall Street jargon, it's a powerful indicator of the U.S. economy's health and a key player in your investments, retirement accounts, and overall wealth. Here's the magic. The S&P 500 is market cap weighted, meaning companies with a bigger market value have more influence. So, when Apple's stock jumps, it moves the index more than a smaller company would. This index moves constantly, reflecting how investors feel about these companies and the economy. If the S&P 500 rises, it usually signals confidence and growth. When it falls, it signals caution or trouble ahead. Now, why should you care? Because millions of retirement accounts and mutual funds track the S&P 500. When you invest in an S&P 500 index fund or ETF, you essentially own tiny pieces of all 500 companies. Diversification with just one click. This diversity reduces risk. Instead of betting on one company, you spread your money across the economy's biggest players. So if one company stumbles, your portfolio isn't wiped out. Over the long haul, the S&P 500 has delivered an average annual return of about 10%. That's why financial advisors love it for building wealth steadily over decades. But it's not just about returns, it's about timing too. Understanding the S&P 500 swings can help you avoid panic selling during downturns and spot opportunities when the market dips. Plus, many economic indicators, like consumer confidence and unemployment rates, impact the S&P 500's movements. When the economy booms, the S&P tends to soar. During recessions, it can plunge. If you're saving for retirement, your portfolio's performance often mirrors the S&P 500. That means your future lifestyle can depend on this index's ups and downs. And it's not just about stocks. The S&P 500 influences interest rates, housing markets, and even job growth. When the index grows, companies tend to hire more and invest more. But beware, the S&P 500 isn't a crystal ball. It can be volatile, reacting to politics, global events, and sudden shifts in market sentiment. No one can predict it perfectly. So what's the takeaway? Learning about the S&P 500 puts you in the driver's seat. It helps you make smarter investment choices, understand market trends, and prepare for financial bumps along the road. Your money's health is tied to this index in more ways than you realize. The more you understand it, the better you can grow your wealth and secure your financial future.